Welcome to our crypto deep dive, folks. Today we're dissecting crypto capital gains taxes across Italy, France, and Germany. We'll break down how profit from selling crypto compares to traditional assets like stocks and real estate.
Oh, it's a fascinating topic. Crypto taxation has really become a maze across different European jurisdictions, right?
Yeah, exactly. So let's start with the basics. When you sell your crypto for more than you paid, that extra is essentially your capital gain, much like you'd see with stocks.
Got it.
Then you apply the tax rate applicable in your country.
Right, and that's where Italy, France, and Germany each march to a somewhat different drum.
Absolutely. For instance, in Italy, crypto is taxed quite similarly to traditional currencies like the euro. So whether you're buying, selling, or even converting crypto into euros, it all counts. And here's something interesting. If your gains in a year exceed 2,000 euros, you
Yeah,
pay a
that's a neat
26%
threshold.
tax rate.
But wasn't there news about Italy planning to bump that tax rate up from 26% to 42%? That's a substantial jump, no?
Right, it is. That potential hike is part of the government's strategy to address fiscal deficits, plus align with upcoming crypto regulations, what they call markets in crypto assets rules. It's like they're trying to tighten the belt on crypto profits.
Yeah, so for short-term traders or those making small gains, Italy might actually look appealing since profits under 2,000 euros aren't taxed at all. But if you're expecting bigger moves, that potential rate jump to 42% could really bite.
Exactly. It definitely makes you think twice about your trading strategy in Italy. Now, shifting gears a bit, let's talk about France.
Yes, France has a different flavor. They consider crypto as movable assets, which means that selling crypto triggers a tax event similar to any other sale of movable property.
Right, and what's really neat in France is the dichotomy between occasional and professional traders. An occasional trader gets hit with a 30% tax rate on gains, but those who trade professionally might face rates up to
That's a
45%.
significant increase. So basically, if you're casually flipping crypto, you're looking at 30%. But if you're doing it full time, it's almost like stepping into a higher tax bracket, isn't it?
Exactly. And there's also a little perk. Gains under 305 euros in a year are tax free for anyone. So if you're trading in small amounts, that threshold can definitely help.
Interesting, though I do wonder for someone who is trading at a higher pace, the tax hit in France might be a real dampener. It almost seems like they're penalizing active traders a bit too much.
I see your point there, and yeah, it's a delicate balance, right? On one hand, they want to tax profits, but on the other, encourage innovation. Then there's Germany, which has a very distinct take on crypto taxation.
Ah, yes, Germany's rules are particularly interesting because of the 1 year holding period exemption. Hold your crypto for over a year, and your profit is tax free regardless of the gain. That's a compelling incentive for long term holders.
Exactly. It's like a built in nudge for investors to think long term. But aside from that, any crypto sold before 1 year is subject to income tax rather than capital gains tax, and income tax rates can vary from 0% to 45%. Plus, there's that 5.5% solidarity tax.
Yep, that certainly adds layers of complexity, right? And then there are exemptions too. For instance, if you have gains under 600 euros per year, you're in the clear. And even crypto income from activities like staking or lending might be tax free up to 256 euros annually.
That's pretty generous for casual investors, really encouraging a low volume trading strategy. But here's something interesting. The classification in Germany is different because crypto is considered a private economic good. So trading profits get lumped into income tax instead of capital gains tax, which is a subtle but important distinction.
Exactly, it shifts the whole approach. Like you're not just looking at a flat gain tax rate, but rather where you land on the income scale overall, which can be quite progressive.
Yeah, and that progressive structure can really affect your overall tax strategy. Considering these differences, the choice of tax residency really depends on your trading activity. Italy might be excellent if you're only generating smaller, less frequent gains
Makes
because of
sense.
that 2,000 euro threshold.
But on the flip side, if you're a high frequency trader or a professional, France or even Germany might offer better incentives, especially if you can hold for longer periods in Germany.
Precisely, but I've got to throw a little critique here. While Germany's 1 year rule is great for long term investors, it might not favor those who need liquidity or who want to actively manage their portfolios. It sort of biases towards a buy and hold approach.
I can see that. Yeah, it's interesting how these policies can shape investor behavior. And it's not just about the tax rate itself, it's also about the administrative hassle. Keeping track of every transaction, especially if you're making frequent trades, really calls for some serious record keeping.
Absolutely. In Italy and France, the process can get quite intricate. You need to precisely record every purchase and sale and then calculate your gains meticulously. In Germany, while the 1 year rule simplifies things for some, the rest of the transactions are still subject to rigorous income tax rules.
Right. And that's where relying on a tax advisor or specialist really comes into play, isn't it? To help tailor a strategy that fits your trading style and keeps you compliant.
Oh, yeah, definitely. Given that the laws are still evolving in many of these countries, getting professional advice is critical. Even the guidance on crypto mining, for example, is still a bit murky in Italy, where mining income might be taxed as personal income or even business income under certain conditions.
It's quite a tangle. Speaking of crypto mining, France and Germany also have different ways of treating it. France typically applies up to 45% tax for mining activities, while in Germany, if you're mining and then selling before a year, you're under that income tax regime too.
Right? And if we throw staking and lending into the mix, it only adds more layers. Germany offers some tax breaks there, but the thresholds are low. It's kind of a balancing act between encouraging innovation and ensuring tax revenues.
Absolutely. And let's not overlook, Italy even has a wealth tax component applying to crypto holdings at a rate of 0.2% per year, which is an entirely different beast of its own.
Yeah, it's like an extra layer of tax that could catch investors unawares if they're not careful with detailed planning.
Exactly. So, summarizing this intricate puzzle, Italy offers a simpler threshold based system, which might benefit less active traders, but with the risk of a tax rate hike. France clearly differentiates between casual and professional trading, and Germany rewards long term holding but can be complex for active traders.
Right on. And to add, each system has its own benefits and pitfalls. For example, if you're someone who prefers frequent trading with small gains, Italy's current rules might work well, unless that jump to 42% kicks in. But if you're more of a long-term investor, Germany's 1 year holding exemption is golden.
True, and for those sitting at the crossroads, seeking advice from tax professionals is practically non negotiable, particularly with regulations still being finalized and sometimes open to interpretation across Europe.
Yeah, it really is a dynamic landscape. Policies today might shift tomorrow, and staying informed is key, right? And it's interesting how these differences not only affect individual investors, but can also shape market behavior.
Exactly, policies drive strategy. For instance, if someone wants that flexible trading environment without the constraints of a long term holding period, they might lean towards France, but then risk higher rates if they're really active.
Right. And it's almost like choosing your own adventure. You decide what fits your investment style best. But let me throw a challenge here. While these national differences are remarkable, some argue that a more unified European standard might reduce compliance headaches. What are your thoughts on that?
Well, I get the point about uniformity minimizing complexities, but crypto is global and so are its markets. A standardized approach might work in theory, but then you'd face the challenge of reconciling different fiscal policies, national priorities, and economic strategies. It's a tough balancing act, really.
True, that's a fair critique. And while harmonization could simplify things, national governments have their own agendas, like Italy's economic strategy to address deficits, or Germany's effort to encourage long term holding following historical precedents like post war hyperinflation.
Indeed. It really brings home how tax policy isn't just an economic tool, but a reflection of broader social and political aims.
Absolutely. And as crypto continues to mature, we'll likely see an even more refined mesh of policies. For now, investors really need to tailor their tax strategies to their own activity and location, or maybe even consider a strategic relocation if the numbers add up.
Yep, that's something many are contemplating. This conversation certainly shows that crypto capital gains taxation is mostly about planning and adaptability. It's not just about making profits, but about keeping as much of them as possible in compliance with the law.
Exactly. It's a game of strategy both on and off the trading screen. And with all the evolving regulations, staying ahead of the curve might be the best investment of your time.
Absolutely. I think we've unpacked some great insights today. It's fascinating to see how countries like Italy, France, and Germany each offer such distinct tax environments for crypto investors.
Yeah, it's been a lively discussion. Thanks for tuning in, everyone. Remember, whether you're trading casually or professionally, always keep a keen eye on your local tax laws and don't hesitate to seek professional advice.